This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to a special edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny. We're pleased to welcome on back my director, Scott Maurer, also a licensed attorney in the state of Florida. And we're going to be giving some opinions, thoughts, and just general guidance on a new executive order that came out on August 7th regarding alternative assets in retirement plans, specifically 401ks. Now, I think a lot of people, when they may or may not have heard about this, might have some differing thoughts, but we kind of want to break down, what exactly this means, helping people to understand, one, what type of assets typically go in 401k plans and why those types of assets typically are what go into them, how these plans are administered, and why these choices have typically been made, and what, at least from a face value, because they did kind of delineate on the actual executive order what they were aiming to be able to be allowed in these plans, and what that kind of means going forward. It's people's, I would hesitate to maybe say responsibility, but ultimately you need to be informed about what's going on with your capital, right? Whether you're someone that likes to be really hands-on, especially like we have here at Advanta IRA, or more specifically, if you're someone that kind of likes to let your money do its thing, for lack of a better term, but especially when it comes to 401ks and you are giving over responsibility to a qualified trustee or fiduciary of that plan to make decisions that are in ultimately and hopefully your best interest, it's important to know what this kind of aims to, put into these plans, because before this, again, there was very, kind of a binary, black and white or vanilla type of investments that would go into these things for a few specific reasons. So let's kind of start at the beginning, right? So your 401k plans, your defined contribution pensions, right? It's kind of the nice technical Jeopardy answer for what these plans are. So when you have a 401k, right, you work at an employer, you will have a multitude of people that participate in that plan. And typically, and this has kind of gotten away from it in recent years, but at least in, I would say, probably the vast majority of plans are treated as an omnibus, right? So you have a coalescing of all of the different capital of everyone that comes in, and they use the purchasing power to go and invest in other different types of assets, right? Now, some plans do allow for different, risk profiles, if you will. Say, hey, do I want to be aggressive? Do I want to be moderate? Do I want to be, really on the low end of my risk tolerance? But basically what that is telling the plan administrator and trustee is that this certain investment profile is what we're going to aim for. And each one of those different profiles will have a multitude of different investments that the plan as a whole is investing on your behalf. So if you're in the aggressive one, it might be a bunch of technology-centered index funds, along with some high growth potential mutual funds, or other different things that are generally accepted to offer more risk, but also more reward. And then scaling down from there, you have more bonds, you have more municipal bonds, maybe in the lower risk profiles. But for the vast majority of these things, it's pretty middle of the road, right? Nothing's going to be too exotic. It's going to be probably some type of mutual fund. Maybe there is some type of direct securities involved, probably rarely. And if they are, they're going to be large, like institutional level holdings of the plan in general in some type of stalwart company. Think your GEs, your General Motors, your IBMs, your Microsofts, right? It's nothing going to be too exotic. It's going to be something you've probably heard of. Well, with this executive order, you have guidance being given by the executive branch to the Department of Labor to allow for more discretion in the types of assets that these plans can actually hold. Back in 2020 or 2022, you actually had a additional guidance being given on updating fiduciary responsibilities, which kind of built on a rule and regulation from 2018, which was an additional update to kind of solidify the, one, liability, and two, what it actually meant to be a fiduciary for one of these types of plans. you've probably heard the word fiduciary in the past, but at its base definition, it is someone that is responsible for acting in the best interest of the responsible party, right? So if you are a fiduciary for the plan, your goal and your responsibility is to act in the best interest of what you are managing. In this case, capital assets, to achieve a certain rate of return and mitigate risk to the eventual, beneficial outcome of the plan. Now, what this executive order aimed, and they actually call it the democratizing access to alternative assets for 401k investors is the tagline for this. And what it aims to do is to allow for these plans, for these plan trustees to allow for things like private limited partnerships or private different stock offerings. It also specifically mentions cryptocurrency as well, in the allowable options for these plans to invest in. Now, I'm going to turn it over to Scott for a few points here in a second, but again, this is a big divergence from kind of the very safe, risk mitigated path that these 401k plans since the 70s have really tried to aim for. And with allowing these types of assets in, yes, you do have the ability to gain exposure to some potentially higher return investments. And again, simple math, if you look at the private markets versus the public markets, the private markets, given a broad enough spectrum of diversification, have, and numbers are numbers, outperformed public markets over the past decade or so. But that doesn't come without looking at the outsized or the potentially outsized risk of what happens when these things go bad. There's not much of a middle ground. It can typically kind of be a binary A or an F when it comes to private investments, and especially depending on cryptocurrency holdings, can be wildly volatile as well. So I'll turn it over to Scott to kind of maybe elaborate a little bit on kind of what this means and how, it comes into play from the investment perspective on what exactly is going to go in these plans and how this can kind of affect you as the plan participant of a larger pension plan.
Yeah, thanks, Alex. Good to be back on with you. I mean, I think when a lot of us in the industry saw these and the initial executive order, the initial reports coming out of, allowing people now to invest in alternatives through a 401k. First thought I had kind of just cynically was you've always been able to do it. Like for instance, the executive order is not changing the law. So at this point, the 401ks have always been permitted under IRS rules to invest in alternative assets. It's been as you mentioned, the fiduciaries, the administrators of the plan that have limited individuals to investing in assets typically as a whole are publicly traded and I guess more secure and giving them, the less liability for managing those portfolios. So again, kind of cynically saying, hey, this has always been allowed. But I think the natural extension, again, for some of us in the industry as well is really how far is this going to go, and really what types of assets, what types of an investment individuals are going to be able to make through their plan. Exactly what is that going to look like? And as of right now, I think it's still up in the air, and that's what we will see over the next several months, a year or so, as this gets rolled out as to what that'll look like. You mentioned, Alex, private equity investments, private loans and mortgages and financing was mentioned, cryptocurrency, real estate, either direct or indirect. That's what the actual language of the executive order says. Is really, what does that mean? Because in the self-directed IRA world that we live in, that's individuals going out and choosing a rental property, an individual single-family home that they want to hold as part of their portfolio, or making a loan from their IRA to a private company or to another private investor, or having a crypto account where you can buy and sell cryptocurrency through your retirement account. So on that level, with a self-directed account that we're accustomed to seeing, will this executive order go that far? I think you and I both have our doubts on that. And I think as you read through some of the executive order, a lot of the literature, a lot of the articles that have come out since the executive order, it's more probably going to take the form when it's kind of rolled out to individual participants as kind of another fund. You mentioned the different funds people have access to now in their 401k that are publicly traded. It's probably going to be more of just another type of fund that individuals can make within their 401k plan. It's going to be a fund that is made up of various private equity, those types of investments all rolled in together, and you invest into the fund. I mean, there's definitely a lot of issues that are going to have to be navigated. And I think you and I, Alex, are well aware of what we see on that side of the table when it comes to alternative assets in retirement plans, accredited investor status, liquidity issues. Certainly the liability, I think, is going to be one of the biggest things that we see become an issue with the 401k plan sponsors and how they are going to try to navigate what's allowed within their particular plan.
Yeah, exactly. And I think you bring up a few of the very good salient points that, with anything when it comes to these kind of legislative issues, and again, it's especially apparent when it has, a direct executive order versus something that is matriculated through the House and the Senate, is that you have a much more kind of like broad application of this, but you really don't have kind of the eyes and the legal eyes looking. It's like, hey, how does this get implemented? The first thing I'd like to touch on really is the liquidity issue, right? So when you invest as a pooled investment fund, right, you're going to have and the degree of issue with this is going to be a broad spectrum, right? If you have a closely held company, maybe you have a very top heavy plan where everyone is, contributing, maximum to this. They're all considered highly compensated employees for testing purposes. It's not necessarily as broad of an issue, but in general, most companies are not like that. Most plans are not like that. You're going to have a large variety of people that participate in, from age to propensity for risk, to actual income earned in that business, right? Rarely do you have a business where every single person that is in that business is making $150,000 to $350,000 a year, right? And that's typically not the case. You're going to have administrators, you're going to have bookkeepers, you're going to have people that are making, from let's say 50 to 75 a year, being the majority of your workforce. And to expose people that are in that income range to things that are either exceedingly risky for them, or again, they're not going to qualify as an accredited investor, and again, dependent on age of these individuals, is going to be a tricky one to navigate from the fiduciary responsibility of the plan trustee. The issues that I see kind of coming up are, let's say you have an older participant of the plan, someone that's over 59 and a half, let's say 60 to 75, right? Well, there are people that are going to be maybe actively taking distributions, and depending on the allocation of assets within this plan, again, this is going to be, in theory and practice, what actually plays out. Well, most private equity investments are inherently going to be illiquid from the initial onset. They're not going to have cash payouts. It's going to be something where, you might have a very cash poor or not a very cash alternative heavy plan. And how does that play out if they need to take a distribution? Well, that kind of remains to be seen. Or if they have something that is the valuations are fluctuating wildly, also, how does that play out? And the other thing that I don't think has really been brought up, or at least I've seen in any articles, one of the reasons, at least we at Advanta kind of saw a precipitous rise in assets back in 2018, was that the Department of Labor redefined fiduciary responsibilities as valuations, right? So for these plans and other institutions to hold these types of assets in retirement plans, if they are acting in a otherwise fiduciary capacity in other parts of their business, the valuations of these things is really tough. And we're, very good at navigating that. But, a plan that otherwise is only invested in publicly traded assets, how do you handle the plan reporting? Right? And what kind of responsibility is going to come back to the trustee of the plan, for this? So it's the regulatory aspect of this as something that I am going to be very interested to watch and see how it plays out, because having, professionally known plan trustees and TPAs and people that administer large plans, I think it's, nice to say, hey, this is available, but I don't see any of these people running to rebalance their plans to invest in a lot of limited partnerships and closed-end funds and cryptocurrency, right? They are very risk averse to the other ends of the bell curve, right? They want to have enough to get returns, but they're not going to be on that right side of that bell curve anytime soon. So again, my thoughts on that are just, it's a big wait and see. And again, it's, people talking about any legislative stuff is always maybe kind of getting tired of hearing that, but especially with as broad of a statement as the White House put out, it is definitely going to be a wait and see, because how do you put this up into practice?
Yeah, I think, again, on a practical, but I think some of these issues, like I said, we have to wait and see how things come about, how things are formed. I think again having a private fund, of basically a couple different funds maybe you can choose from in your 401k portfolio they're tied to the private market. I mean, if the fund itself or it's almost like it's a publicly traded asset, but it's all tied to private assets. The funds that are dedicated maybe 100% to private assets, but there's still something where you do have some liquidity where there is a secondary market for people who do need to exit the investment because they're of RMD age or they're just want to sell the investment. I can see some of those issues being solved with how the funds are created. I think the accredited investor status that has been a barrier for so many people to enter into the private market. I can see again the SEC, the executive order itself even asked the SEC to reconsider the definitions of what an accredited investor means. So I think the genesis behind it is going to be able to allow more and more people to access this. But I have a feeling, again, with the fiduciary liability, I mean, Alex, you and I know what's involved with holding a self-directed asset, a truly self-directed asset, where it's, say a rental property where you have rental income coming in each month to the retirement account, expenses being paid out. The larger firms like Fidelity, Schwab, by extension, all those different brokerage houses have always shied away from those types of assets due to the administrative work that it entails. And I know obviously how much administrative work we do here at Advanta IRA, and you extrapolate that by the a number of different 401k plans that are out there, the number of different participants that have had access to these other types of alternatives. If they really open it up to true alternatives, what kind of administrative nightmare that might be for some of those different custodians. That's why, again, I know there's people out there. What kind of assets are we going to be able to see? I just, my opinion, don't see you being able to go out and buy your own rental property, invest into a neighbor's or a friend or a colleague's real estate syndication. It's going to be kind of only certain investments that have been placed into a private fund that you then have access to through your 401k because of the liquidity issues, because of the accredited investor status. They're going to want to make it kind of as similar, I think, as possible to what 401ks do now. And I think that's, again, from the fiduciary capacity you mentioned with 401k plan sponsors, trustees, unless they relax those rules quite a bit, they have a duty to the people inside the 401k plan to make sure that the assets and within the account are somewhat safer, not as risky, that people know what they're doing. And I think opening up to just truly self-directed accounts, like you can do with an IRA account, is just not something we may see to that extent within a 401k, or at least not probably through this initial round. Maybe things change in the future, but I kind of almost, it's kind of like tiptoeing into the water. What can we make a private investment that's most like what we see private right now to give people those options and give private sources more capital to work with? I think that's part of the genesis too, is not just allowing individual participants the ability to invest in private markets. It's also having private markets have access to the $13+ trillion that are in defined contribution plans. That I think I was reading the numbers. It's $13 trillion in defined contribution and only 2 or 3 billion in defined benefit or something like that. It's a number that's off, and it's trying to open up that bucket of capital to the private markets.
Yeah, and it's going to be interesting as well to see kind of what effect this has on the private markets, right? Because past just what this plays out, which again there's too many questions to really define what a roadmap forward with this is going to look like, because there are so many legal responsibility questions that just on what the trustee's responsibility is and how to actually integrate these kind of assets. Because again, you have 50 years of established plan administration of these things that have more or less, things like ETFs and other different types of investment products have come to fruition, but they've always been on the public markets, right? It's always been either, easily defined liquidity, easily defined valuation standards for this stuff. So you haven't really had the shift for the larger plans to really take in this stuff. And you've always had it for the small, again, the top heavy plans, the doctor's offices, professional service companies, and we've seen that play out time and time again. But to have kind of that, omnibus account going out and investing as a whole for multiple different participants, how does that look? There's just, again, we need guidance. And until, X, Y, and Z is answered, you can't really do the algebra for the rest of it. But I think the more interesting aspect of it is going to be to see the reaction of the private markets is to how this is going to really kind of play out for the investors, right? You have the BlackRocks, you have the Sequoia Capitals out there with, hundreds of billions and sometimes trillions of dollars of assets under administration that are going to really kind of be the big players for the private market. But I think it's really going to, again, bring more eyes to kind of that middle market that we and or I should say our clients operate in specifically, that might really help to bring some more eyes and more health to the market as well. With increased, uh, you know, exposure to different things, I think it might help to drive better practices, maybe some more sound investment decisions on behalf of the providers of these private investments as well. So you might see better opportunities coming up because you have more competition in the market. But again, the reciprocal of that is that how far is the large pension capital, those trillions of dollars going to bleed into the middle market? I think personally, just like with anything, the institutional people are interested in the 100 million plus, right? What's the point in going into these smaller, different offerings? They're raising 5 million, they're raising 10 million. Is it worth their time when they have that much capital to get working? I don't think so. And that's based on, basically the entirety of financial history in the United States, right? The big people are interested in the big stuff. It takes a long time to invest $1 trillion, 10 million at a time, but when you get smaller, it gets a little better. But again, I'd be interested to kind of get your thoughts on where you think this is going to drive eyes and investment, because that's kind of the exciting part. Leery on the regulatory part, how it's going to play out, but there is some excitement to be had from something like this happening.
Yeah, no, absolutely. And just to clarify, I looked up there was 30 trillion in defined contributions, only 12 trillion in defined benefit plans. And again, that's what Alex was saying. Defined benefit plans, those endowment funds, that's been they invest a lot of their funds into private markets over the years. It's now opening up, obviously, a market almost 2.5 times that amount to it. I mean, like I said, I think one of the benefits, I mean, we're talking about some of the potential negatives, obviously, with the liquidity issues, the fiduciary responsibilities. The good thing is it is making people aware of alternative assets. I think in general, there's been a lot of articles written, a lot of publicity about surrounding this executive order. Again, we fight that every day. Most people don't know that you can invest your retirement accounts into other types of assets and other types of holdings. I think it's driven awareness of that, which I think is a good thing. I think that should help a lot of, like you said, the smaller middle market people who are raising capital, the syndicators, the lower end funds. Now that people know this is available, maybe they can't do it through their 401k because it's, again, seeing how this plays out. Some of those investments may not be a direct option, but at least the awareness has risen. So I would think, again, some of those markets should have access to more capital. Downside maybe for some investors who are already playing in that space will be whether you'll see decreased return options, right? Because the more capital coming in, the less they need to pay to attract that capital. So that'll be the interesting, I think, to see with whether do you see any pushback from people who are already in the space saying, hey, I was already in the space getting a great return with the flood of this additional money. My returns are shrinking, and how that kind of play, I can see kind of a seesaw, going back and forth until we reach that right equilibrium of the rates of return versus where the capital is coming from.
Yeah,
so, but again, I think it's a good thing overall. It's raising awareness. People are going to have this ability to do it. It's just a matter of exactly how much freedom are they going to have in choosing these investments, or it's going to be different types of private equity funds that you can invest in that are kind of it's a large fund compiled of a number of different private equity investments. Not one in particular.
Yeah, and I would say that, the other concern with the additional capital being pumped into the market, one of the attractive things for kind of the the restrictions on the barriers to entry to the private markets is the higher rates of return that can be offered through something like a pref return being paid through a limited partnership, or something that they use to attract the smaller pool of investors into there. Is it going to see, you would hope that, greed doesn't play too much of a factor in this, where they say, now we're going to start collecting more fees, paying out less of a return because there's more capital to come in and we don't have to, offer as much to attract people in. Again, that could certainly happen. And we've seen that happen in different, areas of finance throughout history, but you would hope that things like that don't play in. But again, you always have to look at this stuff from the lens of complete pragmatism, right? You have to look at exactly like, hey, what has happened in the past? What does this potentially happen in the future? What effects are these going to have in the nature of the people that are managing these things? And again, I would like to think that, those higher rates of return that come with, adjusted risk profiles and, liquidity issues can be passed on to the 401ks, because at the end of the day, I think most people would agree that solely relying on, Social Security is not going to be enough to maintain almost anyone's, style, lifestyles, right? That's why 401ks exist. That's why IRAs exist, is to offer additional paths and tax benefits to people to save additionally for retirement, to hopefully have more and be able to enjoy their lives as they've grown accustomed to over their working years. But again, you have to be able to hit those goals and not get tanked with, outside risk when it comes to this. And I think, to that point, it'll probably be something where it buckets out, right? You have the larger plans that have the moderate risk profile, the low risk profile, the high risk, and there'll probably be something where it's just another one where you can elect to be exposed to the private markets, right? Again, with the larger pensions that invest, as an omnibus, do you have what barriers to entry do you put up against people? Do they have to be accredited, right, to be able to be exposed to that? Well, if that's the case, then it's not going to address any more capital going in than already exists, because you have the Jobs Act definition in 2013 of accreditation for investing in private investments. So again, it's the effect, but also kind of tempering that with what will actually happen, because we need to understand what it's going to do as opposed to, what effect it's going to have on the markets in general.
Yeah, and I think we'll see, because it's, I think that the goal is for things to start to show up in 2026. So we're here a couple months before that happens. But again, it's going to be guidance issued. There needs to be guidance issued. There needs to be, whether the rules are going to be rewritten a little bit, changes made. So again, I think it's something we'll continue to update people through obviously the podcast, through any webinars that we do here at Advanta IRA. But it's kind of keep posted on it. To anyone who's listening, just kind of continue to follow. I will say things have starting to move ever since the executive order was issued. A couple of things have already been issued by the SEC or the Department of Labor, so they acted fairly quickly on it. Whether that was they were kind of all ready to go, knowing the executive order was coming, but things have a potential to move fairly quickly. But again, it's going to be, I think, before you'll start seeing this lined up in your plan as an option, it's going to be some time. I think that's the unfortunate thing we've seen in our industry with the Secure Act and the Secure Act 2.0 that have kind of put in some new rules into place for retirement plans in the last few years. The law comes out, in this case, the executive order comes out, people get all excited, but it's still several months or a year before you actually see that come to fruition and being able to use what the law changes or entail, basically. So yeah, have some patience with it, folks. Be on the lookout for it. Continue to get the information. Continue to check in with us as well, because we're going to be paying attention to kind of what those changes in the market look like and what's going to be available to the investors.
Yeah, absolutely. Again, it's something just to kind of, make sure that you're in tune to, especially if you're listening to this podcast, you're probably interested in alternative assets, with the Alternative Investing Advantage podcast being the name of the show. So again, just kind of keeping an ear out for it, understanding, how the stuff's going to play out, which is what we're going to, do our best to really kind of stay in tune with, read the publications, read any type of additional legislation that's actually put down and signed into effect. Is something that we're going to be paying very close attention to, whether through guest webinars, blog articles. I'm sure Scott and I in a few months will actually get back on here and give some updates once we get some additional information, because like he said, with issues that come through, like, the Secure Act, just did a webinar on that today. One of the big hangups for SEP Roth IRAs or Roth SEP accounts was reporting. How do you do the 5498 and report that it's a SEP Roth? It took the IRS almost a year and a half to give us a box on a single form. So some things can run a little slow with government, as I'm assuming that we're all familiar with. So again, it's an exciting time. It's a little bit of unknown. So again, with that said, make sure you keep tuning in, and we will keep y'all updated accordingly. With that said, again, I want to thank Scott for being on with us today. It's always good to chat with you on this kind of stuff and bat the ball back and forth. My name is Alex Perny. This is the Alternative Investing Advantage podcast. Thanks for joining with us, and we will see you on the next one.